is Fundstrat's head of research, joining me once again live. Tom, it's great to have you back with me. Thank you for coming on today.
Yeah, Scott, good to see you. Not a great day for markets, but
no. Are you here today to defend your call or to say I was wrong?
Well, a little bit of both. The last 2 days have been really ugly for markets and really tough for anyone trying to defend something looking better in the second half. But that doesn't mean today's CPI report has really negated anything that is underlying supporting a better second half. I mean, I'd say it's been very disappointing, but today's probably a good example how markets are just losing their patience. They really do want to see an improvement in inflation, but so many things that are driving goods inflation have really started to roll over. And I think in some ways, it's just that the pace of that's not happening fast enough. And of course, that means the markets are just becoming nervous.
Yeah, I mean, food, gas, rent, I could go down the list. Every metric within the CPI, Tom, was so much hotter than expected. And part of your view for the second half is predicated on the fact, as you have continually made the case on this program and others, that inflation had peaked and that it would start coming down. And in fact, it doesn't look like it has in some of the most important metrics there are.
That's true, Scott. I mean, the biggest contributor is shelter, and that's going to have a lag to housing prices because it shows up through rent. So that's going to be sticky. But what might surprise folks is that if you look at sort of number 2, 3, 4, 5 contributors, the next 4 contributors, it was cars, used cars and new cars, apparel, and travel. And these are, travel, of course, is still in its revenge travel phase, but car prices are rolling over and apparel is rolling over and furnishings rolling over and new car sales are slowing, but that just is not showing up in the CPI yet. So as much as I think today was sort of a headline miss and I think, a diffusion mix for people that they think inflation strengthening, a lot of things that are set to sort of be disinflationary are just not showing up yet. So I think it'll lag and I think markets are losing patience, but I just don't think it means you got to give up on the second half.
You know what? I mean, markets are one thing. I'm thinking about the Fed perhaps losing patience with how sticky inflation is, how tough their job seems to be, and how much tougher it appears today than perhaps it was yesterday, and what that means for the market going forward, and what the likelihood, frankly, is that the Fed has to be even more aggressive than it initially thought.
You're right, Scott. I think from a market's perspective, I think the market would love to see the Fed do more. I don't think that the shock to markets is that the neutral rate is, 3 or something. It's really the pace and markets' views about the trajectory. And if it means the Fed has to get tougher and sort of front-end load the hikes, I know that might sound like it's a negative development, but as you know, that might really appease market fears. And for those who are worried that maybe this goes too far and breaks the economy, of course, that's a possibility. But as you know, a big chunk of this rise is really energy prices, which as much as the Fed is going to try to control it, it really is out of their hands in the sense that now the second wave is coming from delays associated with Russia and uncertainty. So I understand why investors are nervous. It's been a tough macro environment and a really tough time to be owning stocks. But I mean, I would even say today wasn't necessarily the ugliest day in the sense that, we haven't necessarily broken to new lows, and it was would have been a perfect excuse for us to actually break to new lows today.